Thank you, Fawn. We are now going to proceed to the interactive live Q&A section of our webinar. I would invite all of our analysts to come on video now. And we look forward to hearing your questions. We'll go one at a time. I will call your names, and then you can direct your questions to the management team. First, we will begin with Lance Vitanza, our research analyst from TD Bank.
Thanks, Shirish, and thanks everybody for taking my questions. I'm going to see if I can get two in if I can. The first is, at some point, does concentration of Bitcoin holdings at a single corporation impede adoption of Bitcoin as a store of value, let alone other potential monetary functions such as medium of exchange or unit of account? And if so, when might that point realistically come for Strategy? Is that 5 years out? Is it 10 years out? Is it longer? Is it shorter? Or is it just the wrong question?
I'm sure everybody's got an opinion, but I'll start. I think we're accelerating institutional adoption, but we're also accelerating the adoption of Bitcoin, just like BlackRock is accelerating the adoption of Bitcoin because we're channeling new forms of capital into the ecosystem. And, you couldn't, there's whole sets of capital that wouldn't come into the ecosystem if they don't have an investment grade, credit-worthy counterparty to trade with. So we don't really think there's any number. We're up to 3% of the system. I mean, it's getting exponentially harder. I've said, before, it feels to me like if we get to 5%, Bitcoin's going to be $1 million a coin. And if we get to 7.5%, it's going to be $10 million a coin or some ridiculous amount. If it does get to $10 million a coin, and if we do get to 7.5%, that will mean that 93% of all the Bitcoin is held by somebody else somewhere, and that will cause an explosion of innovation in the rest of the world. For all we know, right, the harder we try to acquire it, the more it will decentralize to other places, because you're going to see an explosion of other innovation because everybody else that's not BlackRock or not us or not whatever is going to have all this Bitcoin that's valued at millions and millions of dollars a coin.
And then just as a follow-up, and Fong, you touched on this, that you've been actively encouraging other public companies to follow in Strategy's footsteps and create their own Bitcoin treasury models. Are you worried that you may have been too successful in making that pitch? And at what point does the plethora of public Bitcoin treasury companies, or PBTCs as I like to call them, at what point does that become a problem for you, either in terms of access to capital or potential for bad actors, et cetera? Thank you.
I can start. I don't think we get to that point. I think the positive of more Bitcoin treasury companies is creating knowledge. As you can see, we're quite understood. And so the more companies there are, the more analysts will cover them, the more retail investors will get involved, the more institutional investors will get involved, the more large banks, and the more there is just knowledge about, for example, how to value a Bitcoin treasury company. And I think we're pretty far from understanding that. Second piece, if they're all buying Bitcoin price is going to go up, which causes our Bitcoin net asset value to go up, which causes our equity to go up, which causes our ability to raise more capital. I don't think we're even close to a place where this capital markets and the credit markets for Bitcoin are saturated. I think we're in the first inning of a 9-inning game, and I think more and more access will occur. And I think they're all, getting started. Look, a lot of these Bitcoin treasury companies are markets that would be very difficult for us to access. Bitcoin treasury company in India, Bitcoin treasury company in Sweden and Brazil. So I think they're all at it. They're all creative right now. And I think they all have their own niche strategy. And look, they're not really close to us in size, right? The place at which they can issue innovative preferred securities might be 2, 3, 4, 5 years out. So even if they did, it's going to take a while. But I think they're great.
And I would say we're not all, the Bitcoin companies aren't competing with each other. We're competing against 20th century credit instruments for the most part, if you think about the fundamentals. you're competing against corporate bonds and preferred stocks, illiquid bonds, illiquid preferred stocks, illiquid credit that is generating normally a 400 or 500 basis point yield. And all these BTC companies are in a position to create digital credit that generates 400 basis points more than the risk-free rate in all their own markets. And, that's hundreds of trillions of dollars. So the real competition is between the credit instruments that come out of the BTC ecosystem versus the credit instruments that are backed by real or yen or euros or rubles or naira or dollars or whatever the other source of credit is. So and that's another way of saying we're all very cooperative. It's good, the more of us there are, the more of those capital markets we can provide a digital solution to. And then the other point, coming back to your first question, is, if you want to sell $100 billion worth of investment grade credit to insurance companies or pension funds that are conservative in the United States, you're going to need a big Bitcoin treasury company to do it. And if you want to sell an equivalent type of credit in Germany, you're going to need a German operation or a Japanese operation to do it in Tokyo. So what's really happening is the digital transformation of credit type assets. They were either backed by, some currency derivative or some kind of, what backs a junk bond? Like the effort of a struggling company is what backs a junk bond. And so we're replacing that with something better and different. And so companies at all scales are needed. You need a monster Bitcoin treasury company in Japan. You need a big one in France, a big one in Germany. But there's always going to be home court advantages and national champions. And the way that we all cooperate is we're all competing for the same 450 Bitcoin a day. And once you bought the 450 Bitcoin, the price of Bitcoin has got to move up, increasing the collateral value of everyone in the ecosystem. And as the collateral value increases, and the other thing we're doing is we're damping the volatility. As we increase the collateral value and damp the volatility, the BTC risk numbers plunge, the leverage increases, and you can imagine you can create a lot more of this BTC-backed credit, which is just a very positive feedback loop. And so we're in a virtuous competition or virtuous cooperative cycle with any company that's capitalized on a Bitcoin standard anywhere in the world.